So the next thing we have for this evening is an overview of the 1040. So this is where we are just hoping to talk about basic tax mechanics. Again, this is also where we are not talking about tax law. So I'm going to defer all tax law to Jared. He's a real expert on that. I'm just going to go over 1040 mechanics. So we're going to open up our 4012s to page B1, B as in boy 1. I know this is kind of difficult to find without the tabs if they're not in yet. The page is titled Form 1040 Job Aid. Okay, so this is the 1040 that we're going to be working on. One of the first things with the 1040 is you'll hear us say a lot, 1040 page 1 and page 2. So the front page of that is your 1040 page 1. The back page is 1040 page 2. So we will be flipping between those two a bit. The PowerPoint slides, most everybody should have a printout. I know we did run out of some of them. They will be emailed out on Friday or the weekend. I will also be referencing this sheet. So this is the second page or the first inside page of that intake sheet. So just one note on this, you'll hear me refer to section 3, 4, and 5. So the first section is 3, then 4, then 5. It does not go 1, 2, 3. Okay. So quickly looking at the 1040, first part of the 1040 is very simple, and again, I'm looking at page B1 and then B2. So the first page of the 1040, first part of the 1040, that's all demographic information followed by dependents. We're not going to talk about those sections too much today. Then we have the income section. So the idea with the income section, as you have probably figured out, is that's where all the income goes. That's where we figure out all of the taxable income. Next, we have our adjusted gross income section. So this is where adjustments go, or we can call them first page deductions, because they're deductions that are going on our first page. So flipping over to the second page of the 1040, up top we have our itemized deductions or standard deductions along with exemptions. Then we have taxable income, tax, and non-refundable credits. After that, we have other taxes. And that's something that we'll talk about, the fact that you have some credits and then more taxes after some credits. After that is the payment section. So you'll notice in the payment section that there is withholding, which is actually money that someone is paying to the IRS in the form of withholding, but also refundable tax credits. So the payment section is really where the fun happens, where people are going to get these nice refunds because of what goes on in that section. Afterwards, we have refund information, amount you owe information, and signature information. So again, that was just a very brief overview of the items that we'll go over. So I'm going to focus first on the income section. So looking at this sheet, the intake sheet, and again, part of what we're doing is showing, you have your intake sheet, so a client comes in and part 3, box 1 has a check mark, which means they have a W-2. So then going back to our 1040, line 7 is where wages go. So we are going to see a lot of line 7 at VITA. And that's pretty straightforward. If people have W-2s, it goes on line 7. One thing to point out here is if people are paid by an employer in the form of a 1099 miscellaneous or have cash income, that does not go on line 7. So line 7 is only folks with W-2s. We'll talk about the miscellaneouses in a moment. So line 7 is pretty straightforward. Moving along, next we have our income. So again, switching back to the intake sheet, I believe question number 4 is asking about interest or dividends. So this is something that we don't see, you won't see this on every single tax return at VITA, but interest and dividends go on line 8A and B. So there we have our taxable interest and our interest that is not taxable. What's nice here is that the form that the client has, the 1099 INT, will tell you what is the taxable portion and what is the not taxable portion. So you do not need to figure that out with these, which is really nice. Banks are only required to give out a 1099 INT if they are paying interest of $10 or over. So a client might come in and say, hey, I want to report $3 of interest from BB&T Bank. That's perfectly fine. If you want to put it on the tax return, you can, but do not expect to see a 1099 INT for anything less than $10. Another interesting thing is dividends paid out by a credit union are considered interest. And that will be reported correctly, but it's kind of just a fun fact that I did not know about, at least until this training. Next, we have dividends. So they are, of course, on the same question on here, but they go on line 9A and B on your 1040. So dividends, you have ordinary dividends and qualified dividends, which, like taxable and non-taxable interest, are taxed differently. What's nice here too is that on the 1099 DIV you will see a box that includes the ordinary dividends and the qualified dividends, so you don't have to figure that one out either. So moving on down in our income section. So next we have self-employment income. So even if someone works for an employer but is paid in the form of a 1099 miscellaneous, this counts as self-employment income and goes on line 12 instead of line 7. So again, line 7 is only for W-2s. If someone comes in with a 1099 miscellaneous or an account of cash income that they received, that is all self-employment income, which goes on line 12. What's fun about line 12 is once something goes on line 12, you also trigger line 27, which is in our AGI, adjusted gross income section. That's a deductible part of self-employment tax. And we'll see why self-employment tax is so unpleasant when we go to the back page. But because it's so unpleasant, they do an automatic deduction for it on the first page, and then line 57 on the back, that's where the self-employment tax actually comes in. So I mentioned this because anytime you get the, again, a 1099 miscellaneous or cash income, that goes on line 12, which then triggers 27 and 57. The problem with putting it on line 7 is that it will not trigger 27 or 57, and then all of the taxes that need to be paid will not be paid on the self-employment income. All right, so moving along, capital gains. So that is question 9 in the third section on the intake sheet. A lot of clients may answer this one incorrectly. A lot of clients will have a mutual fund account. So with mutual funds, all of your capital gains are typically reinvested, so you're not actually getting a check for selling the stock, but they will get a 1099-B. So a client with a mutual fund may say, no, I don't have any capital gains because they didn't actually sell stock, but they have a 1099-B with capital gains on it. So that's one thing to keep track of, especially if you're a basic volunteer, basic certified volunteer. Capital gains are advanced, so even if they didn't check yes for this, just do a quick check and see if they have a 1099-B. It is not something that we see a whole lot of at VITA, but again, something good to keep track of. 1099-Bs cover any stock sales or securities. So Irm Pension Distributions, this is one where I will direct everybody. Please do check it out on here. This is number 11 on the intake sheet. This one's kind of strange because on the intake sheet, you'll see next to the number 11, there's a little A indicating that that is an advanced topic. That is actually we'll say somewhat incorrectly listed on here. 1099-Rs are basic. So if you get a 1099-R, 99% chance it's going to be basic. The only time it is not basic or it is advanced is when the taxable amount is not listed and the simplified method is required, which is very rare at VITA. So the vast majority of 1099-Rs that we see will be basic, even though it says advanced on the intake sheet. So 1099-Rs, like I mentioned with our interest and dividends, there is a taxable portion and a non-taxable portion. Here again, that is listed on the form that you get from the client. So there will be right in front of you the taxable amount and the not taxable amount. Generally they're fully taxable, but we will see situations where they're not fully taxable. So this is another point that's good to go over the 1040. So when you're done with your client and it's printed out, it's always good to make sure that the taxable versus not taxable amount does appear correctly on the 1040. Next is unemployment income. So that's question 12 in part 3. This is a fairly simple one. People get a 1099-G, and that gets dropped onto the 1040 on line 19, thank you. Yep, unemployment is on 19. So that's one of the most straightforward kinds of income that we'll see at VITA. It is not taxable to state and local. Now, something nice with the software is our software is all forms-based. So if you are very good at the 1040 and you get a W-2, you know that goes on line 7. You can just click line 7 on the 1040 and plug it in there. The other thing you can do is a client hands you a W-2. You can just type into the software W-2 and then type all the information into a form that looks just like the W-2. So this example is a good one in that unemployment is not taxable to state or local, and the software knows that. So you're going to put it in, and then it will know not to tax it to the state or the local, but it will throw it on the 1040 for you. Next is Social Security. So this is something that we do see a lot of at VITA. Unlike our pensions, annuities, and interest, there's a portion of Social Security that is taxable versus untaxable, and that is determined by the amount of other income on the tax return. So if a single person has more than $25,000 or a married couple has $32,000 or more, their Social Security will incrementally start to become taxable. So what's nice here is the software will figure this out for you. We caution you though, if you enter in Social Security first, someone may have a very handsome refund, and then you enter in a W-2 for $40,000, and then a lot of that Social Security is going to become taxable. So that just goes to show I would not discuss refunds with clients until you're really done with the process, and especially when all of the income is added, especially when they have Social Security. Again here, the form on Social Security will not tell you the taxable or untaxable portion, but the software will figure that out for you based on its internal calculating of other income. So the last section that we have is line 21. So line 21 is other income, and this is really a catch-all. So what goes on here is gambling income, prizes and awards, jury duty pay, and debt cancellation. Something that some folks try to do is put self-employment down here on line 21. So let's say somebody has $600 of cash income. Oh, we'll just throw it on line 21 and they're paying tax on it. The issue with that is that will not trigger self-employment tax. So again, then you're not paying the taxes on it that you need to. So cash income and self-employment may not go on line 21. Any questions about our income section? Cool. All right, so moving on down, the next section is that adjusted gross income. So again, these are called adjustments or first page deductions. So if you look on your intake sheet, that's going to be section 4, questions 1, 2, 10, and 12. And again, you'll notice that I'm not doing every single line here on the 1040. I'm going over the things that we actually see at VITA. So we don't see a heck of a lot of adjustments at VITA. The ones we do see, line 23, K-12 educator. So if you are teaching from K-12 and you have a certain amount of classroom expenses, you can take them on the first page. Line 27, again, is that self-employment tax deduction. So that automatically goes if you're putting self-employment income on line 12. Line 31A for alimony paid. That's pretty rare at VITA, but you may see it. Next is the IRA deduction. So the IRA deduction is if someone is contributing to an IRA outside of their employer, so it is not reflected on a W-2, that can be a first page deduction. And that's something to keep an eye on as we go through tax law. If there's ever a need to reduce someone's AGI, you can always have them contribute to an IRA, which can reduce their AGI and have other tax consequences. So that's just one thing to keep in mind. The nice thing is if it's tax season, right, and we're doing a 2017 tax return, and someone puts money into an IRA before the tax deadline of that year, it can count on the tax return that you are preparing, if that makes sense. So that's just something good to keep in mind on the front page. The one we probably see the most, line 33, student loan interest deduction. It's surprising and scary what that looks like. I don't want to scare any college students. That's something that we will see a good bit of. One thing we do mention here, line 34, tuition and fees deduction. So there's the student loan interest deduction for folks who are paying off the loans. There's also tuition and fees deduction for folks who are currently in school and paying tuition and fees. We do not use that at VITA. So if you're currently in school and paying, you can either do tuition and fees deduction or take a tax credit. The tax credits are much more powerful than tuition and fees deduction, but they phase out based on income. So that's why there is a tuition and fees deduction, but based on our income limit at VITA, those credits do not phase out. So anytime you are thinking about using the tuition and fees deduction, just raise your hand and ask for a hand, because you probably should be using a credit. And we will go over that during tax law, what qualifies, but again, we do not use line 34, tuition and fees deduction. So that's everything for the AGI section. Any questions on that? Yes, sir.
You mentioned about reducing the taxable income and using an IRA. Just make the distinction about that traditional IRA rather than Roth IRA.
Correct, yeah, Roth is after tax, so it does have to be traditional. Other questions? Awesome. Okay, so I will quickly point to line 37. Line 37 is where the AGI is listed. So we're going to talk a lot about AGI. I'm going through the tax law training. So AGI is adjusted gross income. So that is all of the income less these adjustments that we were talking about. So now going to the top of page 2 on line 38. Line 38 will always be the same as line 37. The purpose of line 38 is really just to repeat that AGI so you have a starting point for your back page. So line 40 is the itemized deduction or standard deduction. And this is something that we will get into detail on. The vast majority of clients at VITA do not itemize deductions. We do need to figure out whether they can itemize or not. Generally speaking, if our client does not own a home, they will not be itemizing deductions. An easy way to figure this out is you have your standard deduction, and we have a list of the standard deductions up here. So it's just over $6,000 for a single person, over $12,000 for a couple. You also have exemptions that come off. So you will get a standard deduction plus an exemption for every person on the return. So if this is a couple, they will get a standard deduction of $12,700, and then they will get 2 exemptions of over $4,000 apiece. So that brings them right up around $20,000. The average income of our clients is just over $21,000, so that's a big portion of our clients. So what that will do is eliminate all of their taxable income immediately. So in that scenario, it is absolutely pointless to itemize deductions, to talk about itemizing deductions, to think about itemizing deductions. So we mentioned this just to show that there's not going to be a lot of times at VITA where we will be itemizing. The second thing, so if the AGI is more than the standard deduction plus the exemptions, we then need to look at, do they have enough qualifying items to itemize? So again, for a married couple, you have to have more than $12,700 of things to itemize, which we're not going to see a lot of that at VITA. And we will talk about what qualifies and what doesn't qualify later on. What's interesting about the 1040 and the software, so let's say that you do have a married couple and you think they might itemize. So you put in itemized deductions of $11,000. You look at the 1040 and it will show the higher of the two. So if you put in itemized deductions and you're upset that it's not showing them, it's showing a different number, it is probably the standard deduction because it is higher. So on line 40, you will get either the itemized or the standard deduction, whichever is higher. After that, we get our exemptions and then our taxable income. So line 43 is taxable income. So that's your AGI less your deductions and your exemptions. After that, our tax is determined. So then on line 48 through 54, we have some non-refundable and partially refundable tax credits. So let's say a client has $10 of tax that they owe, and they have, we'll say, $15 of non-refundable tax credit. That will bring their tax down to 0, so they will not have to owe any tax, but they will not get a check for any additional money. Let's say, though, that the client owes $10 of tax but has $15 in refundable tax credits. Then the tax will be wiped out, 0 tax, but then the client can actually get a check for that $5. So again, that's where the fun happens, is these refundable tax credits. Non-refundable tax credits, the only thing that they can do is eliminate tax. So there are a couple non-refundable tax credits, and again, line 48 through 54 has the non-refundable tax credits. Dependent care expenses is a big one. Again, what you might have happen is someone whose AGI is not high enough to exceed their standard deduction and exemptions, and you're going to take a whole bunch of time to put in their child care expenses, and then you're not going to see it show up on the form. So if the tax is already zero, the non-refundable credits will not show up on the 1040. I'll say that again. If the tax is zero and you put in for non-refundable credits, they will not show up on the 1040. A lot of times people, of course, do have tax though, so that's where we see our dependent care expenses. That is a non-refundable credit. And the retirement savers contribution is another popular one. Fortunately there, that carries straight over from the W-2. But again, a client might ask, well, do my child care expenses help me at all? The answer is kind of, they would, but you don't have any tax anyway, so it's not being used. So that is non-refundable versus refundable credits. There are some credits that are partially refundable. And again, we will get into much more detail about this. The American Opportunity Credit is one of them. There you have a certain amount that can eliminate tax, but then there's also $1,000 that you can get back. So that will actually appear in two places on the 1040, but the first bit comes on line 50. The child tax credit is another one that is both, that is partially refundable. So now we're going to get into other tax. Sorry, any questions about credits? I know credits kind of get a little bit jumbled because we're not talking about tax law. Again, we just want to show where on the form. Okay, that will get even more important here. So you'll notice that other taxes come after credits. So let's say we have a self-employed mother who's paying for her kids' daycare at the Y, and she has no taxable income. So her taxable income is zero. So you try to put in the dependent care expenses, but that doesn't do anything. After that, she's going to get hit with that line 57 self-employment income. That's why self-employment income is so miserable, because non-refundable credits don't affect it at all. So even in her case, that child and dependent care expense would not wipe away that tax because it falls in the other taxes section on line 57. So there are three that we will typically see. Self-employment tax. If people are taking money out of an IRA or retirement account early, they will get hit with a 10% penalty that also falls in this other tax area. And lastly, the ACA penalty for not having health insurance is also an other tax. So again, these other taxes come after your non-refundable credits. So you could wind up with no taxable income, but if you are self-employed, you're going to get taxed on it. Any questions about our other taxes section? That's again why it's so important that we're putting in our self-employment income in the right place so that we can be subject to the miserable line 57 SE tax. Okay, so payment sections. And again, this is the most fun part of the tax return. So anything listed in the payment section can be paid to the client in the form of a check. So what in essence happens here is we see what we're kind of left with. So line 63 right before the payment section is the total tax. So that's the taxable income determined from our AGI, less our deductions and our exemptions, plus other taxes. So that is our total tax. So then what we're really looking at is our total tax versus the payments. So payments include withholding and refundable tax credits. Now the biggest refundable tax credit that we will see is the earned income tax credit. So when we get these big refunds of like $8,000 to $10,000, a big portion of that will be coming from the earned income tax credit. That credit maxes out at about $5,500 and it is fully refundable. So that's why that credit is so powerful. That's why it gets its own slide as well. So that is all in the payment section. So you can think about refundable credits as payments that someone is in essence paid to the IRS and waiting to get back. The other popular one, so there's the net premium tax credit. So if people got healthcare coverage through the marketplace and did not claim the credit through the year, they can get some more credit, which is fully refundable, and then the refundable portions of the partially refundable tax credits. So that's the American Opportunity Credit and the child tax credit. What's nice here, again with our software, is you don't need to figure out which part's refundable, which part's not refundable. You tell the software, hey, this person should qualify for this credit. It'll ask you for some information, and then it will figure out how much is refundable versus non-refundable. Again, the point today is just to show the mechanics of the 1040 and the tax, so that when we're learning about these credits, you can understand how they interact with each other on the tax form. Any questions about all of that? Again, this is why our evening classes go so much faster than the mornings. Yes, sir.
General question.
Yeah.
If it's a couple filing jointly, are both spouses going to be there for the entire performance?
Hopefully. So we do need both people to sign it, so they will both have to appear so that we can review it with them. We do encourage people to come at the same time, but sometimes people can't do that for scheduling, and we'll do our best. But then the other spouse would need to come in to sign at the same time before we file the return.
So they have to come there?
Yes. Good question. Yes, ma'am. Uh-oh. Okay, so this is an ACA topic. I will get into a little bit of tax law. So there's two ways that the Affordable Care Act affects taxes. One, if you do not have health insurance and you do not qualify for an exemption from the penalty, you get penalized for not having health insurance. That's one of the things we hear about a lot in the political world right now. That falls into the other tax section. The other thing with the Affordable Care Act is the advent of the premium tax credit. So when you hear about getting coverage through the marketplace and getting a subsidy, that is actually a tax credit that you're getting, and they are advancing you that tax credit. So one of two things could happen here. You could either get overpaid the tax credit during the year or get underpaid the tax credit during the year. If you overpay, you need to pay some of it back at tax time. If you are underpaid, you actually get more of the tax credit in the form of a refundable tax credit. Does that make sense? It doesn't really make sense, but that's kind of how it is. The frustrating thing about that is not explained to our clients. So some of them come in very happy that they're getting more money back, but some of them need to pay in some because they were overpaid that premium tax credit. And that is all based on an estimate of their income when they sign up in the marketplace. So we will go over that in training, and it is always fun explaining it to clients. Any other? No, so it won't be negative. So that's where you're going to add it back. There is the, there's another line for the other part of it. I do not recall exactly which line it goes on. Yeah, I can't find it real quick. It's on there somewhere. Any other questions? Cool. All right, well, hopefully I didn't scare anybody. Again, the purpose of today was get all of your books, and we will go through the mechanics of the tax form. All of the stuff that was left out regarding what qualifies for certain things, we will go over in the tax law portion, but we want you, again, to just have an understanding of how each part of the tax return interacts with each other. So the next training that we will have, again, will be with Jared. We will cover filing status and dependency. Please bring your binder. I will email out a video recording of this training along with the PowerPoint slides. If you have any questions, we are here and happy to answer them. If you have any questions for us now, Jackie and I will stay for a couple minutes after training. So again, thank you so much for coming out and taking the time. We really appreciate it. If I did intimidate you and you're kind of worried about VITA, please let us know before you drop out and we can talk about it. All right, thanks again, everybody, and have a safe trip home.